Index funds allow you to make an initial investment and then sit back, relax, and watch your portfolio grow. Here we'll look at the best index funds for beginners and their corresponding ETFs. Investing in the stock market can appear daunting, but it doesn't have to be. Technology and modern online brokers have made it easier, cheaper, and faster now more than ever for DIY investors to create a simple and effective portfolio. If you're looking for index funds, chances are you already know index investing is superior to stock picking over the long term, and most active managers and traders underperform the market. Jack Bogle, the founder of Vanguard and considered the father of index investing, preached the majesty of simplicity that index investing allows, making them especially attractive for beginner novice investors. Broadly speaking, index funds usually refer to a fully diversified index across multiple sectors, or all of them, like tech, utilities, financials, etc., and cap sizes, like small, mid, and large, of a particular asset type, or even across multiple asset types, like stocks, bonds, etc. On the other end of the spectrum exist narrowly focused ETFs with ad hoc indexes, such as an ETF for artificial intelligence and robotics. Since we're talking about beginner investors with a long-term approach, here we'll focus more on the former, while also seeking out low fees, simplicity, broad diversification, liquidity, growth potential, and ETFs or exchange-traded funds over mutual funds. So let's dive into the 6 best index funds for beginners. First up is SPY or SPY, the Spider S&P 500 ETF Trust. SPY is the most highly traded ETF. Launched in 1993, it tracks the famous S&P 500 index, which is comprised of the 500 largest companies in the US by market cap. The S&P 500 index is what is referred to as the market, as it roughly approximates the entire US stock market and is diversified across all sectors. This increased diversification provided by holding 500 companies decreases portfolio risk and volatility. That is, SPY can be your entire portfolio, at least for most of your investing horizon until you want to add other asset types like bonds or metals. SPY has an expense ratio of 0.09%. Second on our list is VOO or VOO, the Vanguard S&P 500 ETF. VOO is just Vanguard's ETF to track the S&P 500 index that we just talked about. Think of it as a cheaper SPY. At the time of this video, VOO has an expense ratio of 0.03% compared to 0.09% for SPY. I usually prefer Vanguard funds for that reason. Next up is VTI, the Vanguard Total Stock Market ETF. If you prefer to get some exposure to small and medium-sized companies, you might prefer VTI, Vanguard's offering for the total US stock market. VTI seeks to track the performance of the crisp US Total Market Index. VTI includes VOO inside of it. That is, VOO comprises about 82% of VTI by weight. The other 18% in VTI is made up of small and mid caps. Small and mid cap stocks have outperformed large cap stocks historically, but have suffered in recent years. Because they are more volatile than large cap stocks, VTI will likely be slightly more volatile than VOO. VTI holds about 3,500 stocks compared to about 500 for VOO. Like VOO, VTI has an expense ratio of 0.03%. Next on our list is VT, the Vanguard Total World Stock ETF. We can go one step further and add in international stocks by using VT. This ETF tracks the FTSE Global All Cap Index. This gets you diversified globally with stocks. At their market weight, US stocks account for roughly half of the global stock market. So basically, about 50% of VT is VTI. Most US investors have what's called home country bias, preferring to invest in US stocks, and rightfully so. But it's important to note that international stocks offer a diversification benefit because they do not move in perfect lockstep with US stocks, thereby lowering portfolio volatility and risk. During the period 1970 to 2008, for example, a stocks portfolio of 80% US stocks and 20% international stocks had higher general and risk-adjusted returns than a 100% US stocks portfolio. VT has an expense ratio of 0.07%. Next up is VXUS, the Vanguard Total International Stock ETF. If you prefer to dial in your international stock allocation manually, you can do so with VXUS, which seeks to track the FTSE Global All Cap ex-US Index. In other words, this ETF is composed of all stocks outside the United States. One might opt to build their 100% stocks portfolio using 80% VTI and 20% VXUS, for example. VXUS allows beginners to avoid having to choose between developed and emerging markets, since this ETF contains both. VXUS has an expense ratio of 0.08%. Last on our list is BND, the Vanguard Total Bond Market ETF. If you have a low risk tolerance or a short time horizon, you'll probably want some bonds in your portfolio. Bonds are usually uncorrelated to stocks and are sometimes negatively correlated, meaning when stocks go down, bonds tend to go up. Because of this, bonds can drastically lower a portfolio's volatility and risk. A popular asset allocation is 60% stocks and 40% bonds, known as the classic 60-40 portfolio. Vanguard's total bond market ETF BND is a great choice here, allowing broad diversification across the US bond market. This ETF seeks to replicate a market-weighted US bond index containing both government or treasury bonds and corporate bonds. With BND, beginners don't have to worry about choosing a specific bond type or duration. Adding BND to our previous example with VTI and VXUS results in what's called the Boglehead's 3-fund portfolio, which I have a separate video on here. At the time of this video, BND has an expense ratio of 0.03%. You should be able to find all these ETFs at any major broker. Do you own any of them? Let me know in the comments. Thanks for watching. I am long VOO in my own portfolio.